What if I told you that the gap between people who struggle financially their entire lives and people who quietly build real wealth has almost nothing to do with how much money they make? It has everything to do with a handful of concepts that most people either never learned or completely misunderstood. Today, we are going through the financial ideas that actually move the needle, the ones that separate the people grinding forever from the ones who eventually let their money do the heavy lifting. But quick warning, the last few concepts are the ones almost nobody talks about, and they might be the ones that change everything for you. Let's start with something everyone deals with, but almost nobody truly understands: taxes. You work all month, you check your paycheck, and a chunk of it has already vanished. Federal income tax, state tax, Social Security, Medicare. It feels like getting mugged by a system that also expects your gratitude. Here is the thing, though: taxes are not random theft. They are the price of living in a functioning society. Roads, hospitals, emergency services, food safety regulations, these things cost money, and taxes are how they get funded. Now, there are different flavors of taxation. Income tax hits what you earn, sales tax hits what you spend, capital gains tax hits what your investments earned while you were literally sleeping. And then there is Social Security tax, which is essentially the government forcing you to save for your own retirement, and Medicare tax, which funds healthcare for older Americans. Understanding what each one does and why it exists turns taxes from something terrifying into something you can actually plan around. And planning around taxes is one of the first skills genuinely wealthy people develop. Now, let's talk about where your money actually lives, which brings us to banks. Most people imagine a bank as a giant vault with their money sitting safely inside it. The reality is a little more unsettling. When you deposit money, the bank does not hold all of it. They keep a fraction on hand and lend the rest out to other people. This is called fractional reserve banking, and the whole system runs on the assumption that not everyone will demand all their money back at the same moment. When that assumption breaks, like it did in 2008, things get messy fast. Banks are not your financial guardians. They are middlemen. They take your money, pay you a small interest rate to keep it there, and then lend it out at a higher rate. The difference is their profit. Knowing this does not mean you should distrust banks entirely. In the United States, deposits are insured up to $250,000 per person. But it does mean you should understand that your bank is a business, not a charity, and they are making money off the money you let them hold. This is where things start to separate people fast, which brings us directly to interest, one of the most powerful forces in all of personal finance. Interest is essentially the cost of borrowing money or the reward for lending it. Simple interest is straightforward. You borrow a fixed amount, you pay a flat fee on top. Compound interest is where things get genuinely wild in both directions. When you owe money and you miss payments, your interest starts generating its own interest. A small debt snowballs into something that feels impossible to escape. But when compound interest is working in your favor, on an investment, for example, your money starts cloning itself over and over. Every dollar you earn generates more dollars, which generate even more. The longer time goes on, the faster it accelerates. This is why people talk about starting to invest early with almost religious intensity. The math is not complicated, but the implications are staggering. And if you don't understand this next concept, even that won't save you. This is the silent killer of wealth. Speaking of money losing its edge over time, let us talk about inflation. You have definitely noticed that things cost more than they used to. That is not a coincidence. Inflation is the slow, steady process by which money becomes less valuable. Your $20 bill is still technically $20, but what it can actually buy keeps shrinking. Inflation happens for a few reasons. Sometimes there is too much money chasing too few goods, which drives prices up. Sometimes supply chains break down and production becomes more expensive. Sometimes people simply expect prices to rise, so they buy now, which creates the very price increases they feared. A little inflation is actually healthy. Around 2% annually keeps the economy moving. But when it spikes, savings get quietly destroyed. The government typically fights serious inflation by raising interest rates. which makes borrowing more expensive and slows down spending, eventually cooling things off. The lesson here is that keeping all your money in cash long term is not actually safe. Inflation is slowly picking your pocket. Every so often, the whole economic party hits a wall, and that is when recessions happen. A recession is technically defined as two consecutive quarters of economic contraction. In real life, it means layoffs, stock market drops, businesses closing, and a general sense that everyone is tightening their belts at the same time. Recessions can be triggered by high interest rates, strangling borrowing, global crises, or simply the natural economic cycle completing another rotation. Boom, peak, contraction, recovery. It is a pattern that has repeated throughout history. The uncomfortable truth is that recessions are painful, but they are not permanent. Governments respond by cutting interest rates and injecting stimulus into the economy. Eventually, spending picks back up, hiring resumes, and growth returns. The people who do the worst in recessions are the ones caught with no financial cushion. The people who survive and sometimes thrive are the ones who prepared before the warning signs appeared. Now, here is a concept that controls your financial life, even if you never think about it: your credit score. This is controlling your life, whether you realize it or not. This three-digit number between 300 and 850 determines whether you qualify for loans, what interest rate you will pay, and in some cases, even where you can live. It is not a measure of wealth, as someone can have millions of dollars and a terrible credit score. It is a measure of trustworthiness to lenders. The main factors are payment history, how much of your available credit you are using, how long you have had your accounts open, what types of credit you carry, and how recently you have applied for new credit. The game is beatable once you understand the rules. Pay on time without exception. Keep your credit usage low relative to your limit. Let accounts age without constantly opening new ones. Ignore credit completely for long enough, and your score quietly collapses. Tend to it consistently, and it becomes one of your most valuable financial tools. Here is something that sounds philosophical but is actually deeply practical. Money is not real in the way most people assume. There is no inherent value in a dollar bill beyond the collective agreement that it has value. The same logic applies to gold, to Bitcoin, to any currency. They work because enough people believe they work. The moment enough people stop believing, the value evaporates. The government prints money, central banks regulate how much exists, and people trade it for goods and services. Print too much and inflation destroys its purchasing power. Restrict it too tightly and economic activity seizes up. Understanding that money is fundamentally a social technology built on shared trust actually frees you. It means the goal is not to worship money, but to learn how it moves and position yourself accordingly, which leads directly to investing, which is truly how ordinary people build real wealth over time. Inflation is constantly eroding the value of cash that just sits still. Investing is the solution. You can buy stocks, which are small ownership stakes in companies that grow in value as the company grows. You can buy bonds, which are essentially loans you make to governments or companies in exchange for interest payments. You can put money into funds, which spread your investment across dozens or hundreds of companies at once, reducing the risk of any single one collapsing on you. Real estate lets you buy property and generate ongoing income. The common thread through all of it is that your money is working instead of sitting. Markets rise and fall. Short term volatility is real and sometimes frightening, but the genuine long term danger is not a market crash. It is never investing at all, while inflation quietly dismantles everything you saved. Now, let us talk about something that determines more about your financial ceiling than almost anything else: value. Not monetary value in the abstract sense, but the real world value you create for other people. Gold is worth more than a plain rock, not because it is objectively superior, but because humans collectively decided it was rarer and more desirable. A luxury handbag is worth 100 times its production cost because perception drives pricing. A doctor earns a high income because the service they provide matters enormously to the people receiving it. Steve Jobs built extraordinary wealth because he created something millions of people found genuinely useful and compelling. The formula is consistent. Create something of high perceived or real value, and money follows. The people who figure this out stop asking how to earn more money and start asking how to deliver more value. And finally, the concept that ties everything together: time. Not as a philosophical idea, but as a literal financial instrument. Most people trade time for money on a one-to-one basis. You work an hour, you earn an amount. Stop working and the income stops. The shift happens when you begin using money and skills to create income that does not require your direct time for every dollar. But nowhere does time become more powerful than in investing. The math of compound growth means that someone who starts investing modestly at 25 will almost certainly end up wealthier than someone who invests aggressively starting at 45, not because of talent or luck, but because of time. Decades of quiet, patient growth compound into something extraordinary. The earliest financial decision you make today is worth more than the largest financial decision you will make in 20 years. That is not motivation talk. That is mathematics. The people who understand these concepts and actually apply them do not live dramatically different lives on the surface, but underneath, their money is moving in an entirely different direction. Now you know where to start, but here's the real question: which one are you actually going to use? Let me know in the comments. And if you want to take this further, I'll show you how I put an extra $10,000 in my pocket right here. I'll see you there.